So one of the things we're trying to do is we're trying to figure out how to spend our time. I'm going to go pretty quickly through this. I've been on 9 or 10 podcasts in the last couple of months. One of the questions they're always asking, Jonathan, is how are you spending your time? And I actually don't feel like I have extra time. I feel like I'm working probably more hours than I have maybe ever worked, maybe since 2008. But I've enjoyed some of the things that people are doing with their time. And I don't know if you've seen these challenges, but the Rijksmuseum, I think I said that right, the Rijksmuseum in Amsterdam issued a quarantine challenge. So did the Getty Museum in Los Angeles. They asked people to choose their favorite painting and recreate it using common household items. So here we have, some laundry, a plastic bag, a towel, some paper bags, all put to good use to create what was the Piebald Horse. I don't know if I'm saying that right, by Paulus Potter. It was painted between 1650 and 1654. That's pretty good representation. This is my favorite. Here's the laundry day. This is the portrait of a woman holding a pair of gloves, painted by Franz Hals, 1637. I love how they recreated it with toilet paper. And finally, everyone knows Rembrandt, right? This is Rembrandt's old man in military costume, this was on Facebook, and the person who did this wanted to make sure that we knew that brush was used on vegetables, not on toilets. So this is one of my favorite things. One of the things that people can do is they can, in this time home alone or home trying to figure things out, is there's this thing called mental accounting. And turns out it's a great saving strategy. So we all do this, and what it is it's if we put money in one basket and that basket is for a certain thing, we tend not to use that basket for other things. So this was written in Grow, which is I think an Acorn publication. And the author wrote that after housing and food and utilities, she had $1,200 left over. This is what she put it in. She put it in one account named Uncle Sam, right? What's that for? Taxes. One account named Honeypot, which was her name for her emergency fund. Another account named Other People's Weddings. So she was obviously in her late 20s or early 30s. She meant this literally. She put money aside in an account that helped her save for other people's weddings. And then the best one is her Mosby fund. Mosby is her dog, and her dog has his own emergency fund. And given what we've spent on Posey, our cat, in the last couple of years, I think this is a really good idea. You should have an account with your pet's name on it to make sure that you're reserving funds for the tooth that needs to get pulled, or for the whatever that might deworming that might occur, whatever illness that the cat or dog might have. So I'm going to start going through this. So this is the first quarter of 2020, and then followed by the first half of 2020. And you can kind of see that in every single circumstance here, the first quarter was bad, except for the bonds, which you'd expect that'd be the inverse. And then the second quarter, which means the first half, right? Second quarter was a recovery. This is what I call textbook volatility. Way faster than we anticipated, that Scott had referenced earlier. But it did trigger in our offices some very specific actions. And I want to put this in context. And what I'm going to do right here is I'm going to just, I want to have a rebalancing conversation in the context of this volatility. So the first quarter ended the longest bull market in US history. The broad market dropped very quickly from February 19th to March 23rd, again, fastest ever. And it triggered in our offices a rebalance conversation. And we always like to build into this presentation some of the things that we've been doing on your behalf. And I want to talk about rebalancing, and then the original setup of asset allocation, and why we do those two things in this context. Right about here, you see me circling this dip that happened this big day where we saw this blue line go down here. That was one big negative day. And it was that day that I sent I think it was that day that I sent the video out to everybody saying, hey, this is a 20% decline. This is the end of the long-term bull market. And it's that day that started the conversation in the office about, hey, we probably need to do a rebalance. And within that next week here is when we did that rebalance. And every time we see exceptional volatility, at that 20% mark is when we start asking that question, whether it's something does really, really well between rebalancings or something does really, really poorly between rebalancings. We have a conversation about, do we rebalance as an opportunistic thing? Now, what does that mean? If every client that comes into our office, each and every client has a portfolio designed specifically with the highest probability of reaching their life goals, retirement income they cannot live, sending kids to college, whatever those goals are, we create something that's got the highest probability of being successful. And I always have to use the probability because we can't, we don't know how things are going to unfold. So that highest probability is, in this circumstance, we set up, okay, you need a 60% equity, 40% fixed income. And then right around March, we lost 20% in our equity portfolios. So what that means is the portfolio started at 60-40 and it moved to 48-52. And this is kind of it's loose because in this circumstance, fixed income didn't change at all. Ordinarily, and it happened this time as well, fixed income goes up. So you end up actually at 45-55 or something like that. So what that means is the safe assets are now too big of a portion of the portfolio. And when markets begin to recover, we will not recover as fast as we'd like. So what we do is we create a rebalance. We sell some of that quote unquote safe fixed income and we buy some of that more risky equities. Now, when we did that, we didn't know where the markets would go. So if the markets would have continued down another 20%, we may have rebalanced again. However, they didn't. They turned almost immediately and went right back up to where they are today, where you see things like the NASDAQ today. It wasn't by the end of the first half, but today the NASDAQ is at a new high. The S&P is up within 2-3% at the end of the quarter, 2-3% of its beginning of the year value. So that rebalance actually added a lot to our recovery time. I had a conversation with a client today, and he asked the question, why did my 401k that is managed in the 401k, why did that not recover as quickly as what you guys have here? It's kind of the same breakdown. And I said, well, it had a lot to do with the rebalance. And that is something that we do on a regular basis in order to keep the risk return metrics in the portfolio the right way to fit your plan, because we know where you're trying to go and we're trying to get you there in the highest probability fashion. So that is what rebalancing is all about. It's we're returning the portfolio to its long-term strategic allocation that has built into it risk return expectations. So we want to maintain those risk return expectations. As always, markets, you can see this in the second quarter. This is an estimate in the first quarter. As always, markets react to an expectation of a change in earnings. So this is what happened in March and April. So March and April, markets collapsed because they expected earnings were going to get bad. And earnings in the first quarter turned out to be a little bad. We're estimating earnings in the second quarter are going to be even worse. And I'm being reminded that the rebalancing procedure is an automatic, idiot-proof method of buying low and selling high. If all you do is on a calendar basis, once a year rebalance, every single year you buy low and you sell high. When you add that opportunistic piece, you're buying low and selling high, kind of at an extreme point, which is something you really like to do. Which you can't time, you can't guess when it's going to happen going forward, but you can see the data you have and manage the portfolio with those future expectations. So people are often asking me now, Jonathan, why have markets recovered? It seems like they might have got ahead of themselves a little bit. Well, markets are looking at this. They're looking at the expectation of earnings recovery. Just like if you looked at the earnings that were actually being reported in the fourth quarter of 2019, the earnings were fantastic. And looking forward in the first quarter, starting out that quarter, markets were doing really, really well because they expected that to continue. And then COVID, expectations changed, markets dove, and now we're trying to sort out, okay, how is that actually going to affect earnings? And we're assuming that it's going to affect, I'll get to that, David. Thank you, though. We're assuming that earnings are going to recover, and there's no reason not to think that that's going to happen. We are already seeing evidence of that. When you think about the earnings that are reported so far in the second quarter of this year, they are 70% of companies who have reported so far this year have surprised on the upside relative to low expectations, but 70% have surprised on the upside in terms of revenue, and 80% have surprised on the upside in terms of earnings. So this 43.9 was an estimate before all this stuff came in, and so far the things are coming in better than expectation. A lot of people are revisiting third quarter and fourth quarter, and what they're saying is it's actually going to be a little bit better than we expected. These get revised all the time, and depending on how this current bout of infections goes through and how we see those deaths go through and how we see states and municipalities respond with further lockdowns, further limitations on economic activity, we may see some downward revision. And if we see downward revision, we'll see stock prices actually reflect that downward revision as well. So the reality is, in all times, in all places, all of these things, sales growth, product demand, profit margins, cost controls, these are all things that people are estimating will be in terms of how that affects their earnings of a company and how it affects future stock prices. And this is the American Association of Individual Investors. Yeah, sometimes investors get the estimates right, sometimes they get it wrong, which is why from a planning perspective, we always say, let's have some cash on the sidelines and let's have some contingency plans. Let's know which portions of our portfolios we go into for income in that circumstance where markets aren't behaving the way we expected, because that's what markets do. They don't behave the way anyone expects. All right, David, this slide was specifically for you. He made a comment in chat to us that we also have a bunch of liquidity from the Fed. So on March 23rd, the Federal Reserve basically pledged to use every trick in the book to provide liquidity and cash for American families and businesses. It slashed Fed fund rates to zero. They started buying treasuries and mortgage-backed securities. They're even buying corporate bonds and corporate bond ETFs. And the Fed isn't the only, central bank on the planet. All of these central banks are doing it. And monetary stimulus isn't the only thing that's happening. So on the very right side, there's a lot of action here. Look on the very right side, there's two. There's an expectation for 2020 in terms of what government spending was going to look like. And then there's the revised expectation. Notice we're going from, what is this, $500 billion to $6 trillion, and we're nowhere near done yet. Governments around the planet around the globe are going to have to actually spend more and more and more through this. This is precisely the scenario that government spending is designed to fill the gap during. And we will see more of that spending. We're going to see some, maybe not by the end of today, but by the end of this week, we're going to see some additional, and we're going to see some additional because states need more, and they're not going to see it. They're not going to see enough in this go around, I don't think. We're going to continue, hashing out, having arguments and discussing it as publicly as possible, because these Republican politicians have to be seen and have to be on video saying, well, we've done our best, and we have to prove that we've done our best, and that's how they're going to attempt to get reelected. That's how the politics of this works. Federal Reserve Chair Jerome Powell has said that, and this is really important, the burden of this downturn isn't going to affect everyone equally. And I'll just say, financially, it's in March, it was a question. We didn't know how bad it was going to get. And so in March, we had internal conversations with folks in the office saying, we don't know how bad this is going to get. Maybe we should batten down the hatches a little bit. And so we did, but it recovered so quickly in terms of what we do. We've had to work really, really, really hard to talk to clients and help people out this whole time frame. But I am, and most of our clients are pretty well protected. There's a lot of folks, and we've referenced them here already today, that are low-income households that are working in restaurants or retail, and I'm not talking about kids families whose 15 or 16 or 17-year-old are working in that. I'm talking families where adults are working in those things, or they're cleaning homes, or they used to clean hotel rooms. And those jobs, those people, that's where this is hitting the hardest. Coming out of this, and we're going to have a lot of conversation around wealth equity. And we need to recognize that there's an enormous amount of wealth inequity, and there's things that we can do to improve that at the same time as, maybe raise some taxes on folks like me, frankly, like many of our clients. And we're going to see that conversation happen in the next 6 months, a whole bunch. Scott kind of alluded to this earlier. Everything about the economy is dependent upon the outcome around health outcomes and a vaccine and better treatments. And I've listed this here. I don't know anything more than you guys do about this. I do know that I read something earlier today about there are 4 items in phase 3 trials. The first vaccine, if it gets through phase 3 trials, with success, will be in a position to be approved in September. That doesn't mean that we have any availability. It doesn't tell us who's going to get it. But that movement of technology and science forward is happening. It's happening faster than it's ever happened. Eventually, whether it's fourth quarter of this year, first quarter of next year, second quarter of next year, we are getting better treatments. We've seen that. We will also have a vaccine that will actually change a lot of the tenor of this. But the outcome of the big economic question depends a lot on this science that's being done. So one of the things that's happened, and this is, you see the gray area there. This is February, early March of 2020. This is everyone on Earth, not just US citizens, but everyone on Earth. Why? I'm curious about, hold on one second. Can we? Okay, there we go. Everyone on Earth buying treasury bonds. And so this is the yield, 10-year treasury constant maturity yield. And we saw in early 2020, the yield on 10-year treasuries go to a new low. Our risk-free rate of return in the United States is now 0.65%. That means anything over 0.65% is taking some kind of risk. And I would say that even at 0.65%, you're taking risk of rates going up, because if rates go up, the bond price on that 10-year treasury is going to go down. So treasury yields have dropped. Remember last year at this time, we were talking about this inverted yield curve, where the front end of the yield curve, the short-term debt, was actually paying a greater rate of return than the medium-term debt. We now have it's not steep, but it's steeper yield curve. It's just lower than anything we've ever seen. The 30-year treasury is paying about 1.4. That is, I don't know what that means. That is something we've never expected to see. What it does to our fixed income part of our portfolios is it means that it will not. There's no way that fixed income can provide the kind of returns it has in the past. We are now at a whatever, the bottom of the yield curve, the top of the valuation curve of bond markets, and this is the end of the bull market in bonds. You have to remember, those of you who have come and seen this presentation before live, we have said this before. We have said bond rates can't go any lower. And in fact, they are lower in Japan and Germany. They're negative. But even if these were to go slightly negative, the 10 years to go negative, it can't go very negative. Like, can we have treasury bonds that pay a negative 0.2%? Maybe. Negative 2%? Never say never. It seems very, very unlikely. So there's not a lot of upside in fixed income. It's still something we want to have in portfolios as a protection. But if you have a fixed income portfolio that's paying 4.5%, 5%, you're almost guaranteed at this point that the value of that portfolio will go down. It has to be paying out principal as income to create that kind of a yield. And there's just no other way around that.